Simon Maughan, Head of Sales and Distribution at MF Global. So that's what we have to see, Simon. You're saying that essentially we have over recapitalization of the banks in some cases. Is that something that we're realistically likely to get?
Well, more details have been emerging overnight about what exact form the plan will take for banks. It looks like a 9% core capital ratio will be required under existing standards after allowing for sovereign haircuts. But that's geared up to be roughly equivalent to 7 percentage points of core capital under Basel III. So in effect, what the Europeans are proposing is to bring forward recognition of Basel III till the end of 2012.
Do you see any immediate form or vehicle for this recapitalization, Simon?
No. And obviously people think that the EFSF has to be the one, and then it's a case of can you leverage it to the amount that is required to deal with both the sovereign situation and the bank recap. I mean, yesterday we were talking about numbers as high as 350 billion euros because of the idea of a 9% core capital. Strip out the adverse stress test element, however, and you get a figure that's probably closer to the 150 to 200 billion range that the IMF suggested was necessary. But the key point here is, given that that figure is out there, if it comes in at less than 200 billion, then not only will we have lost the shock element of this, because we've been talking about it for 2 weeks before it gets announced, we'll have lost the awe as well.
I've got to say, Simon, so many investors and analysts that you speak to say, look, the big thing with the banks right now is this complete lack of clarity. What are the risks that even 200 billion euros not going to be enough?
Well, the crisis is because Germany has a huge surplus on its current account, and the peripheral countries of Europe have a huge deficit. I mean, obviously recapitalizing banks is not going to change that one bit. What I would personally be doing if I was looking to make a one-shot solution to this crisis would be looking hard at the German economy and why it is set up in a way that promotes exports at the expense of consumers. I think a privatization of the German banking system, allowing banks to profit maximize, allowing them to do things like issue more mortgages, credit cards and personal loans, that's the way you'd rebalance the German economy from exports towards consumption, and that would be the ultimate solution for the Eurozone crisis. But I don't see that on the agenda.
Yeah, but how much demand do you think there would be for those loans from, say, individuals and businesses right now?
Well, you don't know till you try, but the reality is, it's extremely difficult through a combination of restrictions on banking, ownership of banks by political bodies, and of course restrictive property laws, to have any kind of consumer-led economy. And the German economy is deliberately set up that way. Basically, the system exists to promote exports, and it's a model that's been copied in Korea and China, with the equivalent consequences for their banking systems. That ultimately is what we're talking about as a proper solution to this crisis, as a stopgap. And we could argue that this is already Plan B, there's no Plan A. As a stopgap, recapitalization of the banking system is enough to lift sentiment. But as I say, it's not enough to change the long-term structural problems of the Eurozone.